Hello everybody. Welcome to our Proactive Tax Planning Workshop. Today our goal is to provide helpful information to those who are about to or have already filed their 2021 income tax forms, and also provide some proactive tax planning ideas for 2022. Before I begin, I find it is always important to review that there are 5 key areas of financial planning. These areas are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Even though today's presentation is about tax planning, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Proactive tax planning should always be a key focus when reviewing your financial situation. We believe that a proactive approach to looking at your tax situation can lead to better results than a reactive approach. Tax laws seem to always be changing. Recent legislation like the CARES and SECURE Acts made significant changes that could affect your 2021 and 22 taxes. One of our goals is to point out as many tax savings opportunities and strategies as possible for clients. This workshop will review some of the broad tax issues and some potential tax reduction ideas. As we go through this workshop, please remember that not all ideas may be appropriate for your personal situation. This workshop is for informational purposes only, and we always recommend that you address any tax strategy with your tax professional. First, let's look at some helpful information for filing or understanding your 2021 taxes. In 2021, there were still 7 federal income tax brackets. Here are the tables for 3 of the most common ways taxpayers file: single, head of household, and married filing jointly. The amounts in each bracket were slightly adjusted from the prior year due to inflation. The lowest bracket of the 7 tax rates is 10%, and the top tax rate is still 37%. Also, the standard deduction, should you itemize, is shown for each category. Should you itemize, a major change that still has a big impact from the 2017 Tax Cuts and Jobs Act is that the state and local tax deductions that you can take, often referred to as SALT, is limited to a combined total of $10,000 or $5,000 for married taxpayers filing separately for state income and property taxes. This deduction limitation is currently set to remain through the tax year 2025. Long-term capital gains were still taxed in 2021 at favorable rates, so they can be more tax efficient than ordinary income. Those rates are 0, 15, and 20%. So long-term capital gains are usually better tax-wise than many other types of income. Charitable donations are still deductible for those who itemize. For those who are itemizing, in 2021 you can take deductions up to 100% of your 2021 AGI, which stands for Adjusted Gross Income. This is up from 60% under the Tax Cuts and Jobs Act, and this is for cash contributions to qualified charities. However, if you do not itemize, starting in 2020, the CARES Act created a new charitable deduction available to taxpayers who use the standard deduction and do not itemize their deductions. This new benefit, known as a universal deduction, allows for an above-the-line charitable deduction of up to $300 for single filers and $600 for joint. To qualify, the charitable gift must be cash or cash equivalent, made to a qualified 501c3 charity, and should have been made on or before December 31st, 2021. As the tax form here shows, it is line 9 on your tax form. Retirement plan funding, for those who can, is always something to consider. If you have not already funded your retirement account for 2021, there could still be opportunities to do so. To explore if you can, please check with your tax preparer or call us for more information and details. Here are some commonly overlooked tax items and deductions. First, reinvested dividends. This is not a tax deduction, but it is a calculation that is important for tax purposes. Many investors have mutual fund or stock dividends that are automatically used to buy extra shares. Remember that each reinvestment increases your tax basis in that fund. That will, in turn, affect your capital gain calculation when you redeem shares. Please check that your statements keep good records. Forgetting to include reinvested dividends in your basis could result in double taxation of the dividends, once in the year when they were paid out and immediately reinvested, and later when they are included in the proceeds of the sale. If you're not sure what your basis is, ask the fund or us to help. Carried over items from prior years. Don't forget items carried over from prior years because you exceeded annual limits such as capital losses, charitable contributions, and certain tax credits. Please make sure if you switch tax preparers that they see your prior year's tax return to look for these items. Charitable gift directly made from an IRA. Individuals at least 70.5 years of age can still exclude from gross income qualified charitable distributions known as QCDs or qualified charitable distributions. These come from IRAs and can be up to $100,000 per year. These distributions must be made directly to the charity. Remember to double check on what counts as a qualified charity and distribution before using this tax strategy. Please note, if you use this strategy, remember to tell your tax preparer to make sure they properly calculate your taxes. Now, let's look at some helpful proactive tax planning strategies for 2022. The IRS has released 2022 tax brackets. There are still 7 federal income tax brackets which have been slightly adjusted for 2021. Long-term capital gains are still currently scheduled at favorable rates for 2022. It's never too early in the year to start contributing to your retirement plan. Here are the current 2022 retirement contribution plan limits. If you have any questions about your retirement plan, please give us a call. You might want to examine taking advantage of annual exclusion gifts. For 2022, the maximum amount of gift tax exemption is $16,000 per person. For example, you can give up to that amount to a family member without having to pay a gift tax. Some ideas for annual gifting can include contributing to a working child or grandchild's IRA, or gifting to a 529 plan, which is a tax-sheltered plan for college expenses. Also, it could be helpful to formulate a 2022 tax projection. We already know the 2022 rates. A qualified tax preparer should be able to review your 2021 situation and all your 22 expectations for income, so they could provide you with a 22 tax projection. Here are some additional proactive tax planning strategies because we believe that taking a proactive approach is better than a reactive approach, especially regarding income tax strategies. For some people, exploring a Roth IRA conversion could be helpful. Some benefits from Roth IRA conversions include they could lower your overall taxable income long term. The Roth IRAs also enjoy tax-free compounding. They also have no RMDs at age 72. And lastly, Roth IRAs allow tax-free withdrawals for beneficiaries. Whether to convert part or all your traditional IRA to a Roth IRA depends on your situation. It is best to prepare a tax projection and calculate the appropriate amount to convert. There are several pros and cons to making this change. Please call us or talk with your tax advisor to see if this makes sense for you. If you're close to the standard deduction level, a strategy to consider is bunching your charitable donations into a donor-advised fund. As this example shows, someone who is slightly over the standard deduction each year can bunch 3 years of charitable contributions into a donor-advised fund in year 1. This could bring that taxpayer a much larger overall tax savings over, in this example, 3 years. Then, as the other side of the screen shows, from your donor-advised fund, you can still give your favorite charity money each year. Now is the time to explore it if it is helpful for your tax situation to deposit cash, appreciated securities, or other assets into a donor-advised fund, and then distribute the money to charities over time. For more information on this strategy, give us a call. A critical area to review in tax planning is what we refer to as overall family tax bracket management. If you have retirement assets that are not in a Roth IRA, when and who takes distributions can make a huge difference from a tax standpoint. Simply put, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions in their tax bracket rather than you in yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your bracket, convert these accounts to Roth IRAs, and leave them account that still must be taken out in 10 years after your death, but can grow tax-free for up to those 10 years, and withdrawals are tax-free. A key step is to explore considering your marginal tax rate and your beneficiaries' marginal tax rates each year. That is something we try to think about for clients with large retirement accounts. Qualified charitable distributions are still a strategy for retirement savers in 2022. This provision allows retirement savers to directly distribute up to $100,000 to eligible charities straight from their retirement accounts after age 70 and a half and not pay tax on this distribution. One idea that experts suggest is if you are charitably inclined, consider using part or all your required minimum distribution or RMD if you're over age 72 for qualified charitable distribution or QCD. Like many of the other strategies we are discussing today, this is one you should see us about if you're interested in evaluating your situation. So what can you expect from us? You can expect regular communication, more frequent discussions, and you can expect that we are frequently reviewing economic, tax, and estate investment issues for our clients. We hope you've received our special tax report. If you haven't, or if you'd like a copy sent to someone you think may benefit from the information in it, please give us a call and we'd be happy to share this report. Thanks again for your time today. Remember, your health and well-being is always our highest priority. We appreciate the opportunity to assist you with your financial needs. We would like to help others in 2022. In fact, we would be honored if you could share some names of friends we could forward this presentation to or add to our mailing list so that they can benefit from our information. Thank you again for your time today. And remember, a proactive approach can many times lead to better results than a reactive one.